Welcome to a new video. Today we'll be going over 5 undervalued dividend stocks for May 2024. And just keep in mind that these aren't stocks that I would necessarily buy, but these are stocks that I would probably take a deeper dive into because they are trading at pretty attractive valuations. So let's jump straight into it. We'll be starting off with Nike, which is in the footwear and apparel industry. This stock is currently trading at around $91, and it is down around 26% in the past year. As we can see from their valuation ratios, it currently is the cheapest it has been in the past 4 quarters because the price to earnings ratio is lower than the average of 30 times and the price to cash flow ratio is again lower than the average of around 24 times. What's good about Nike is that it has a very solid dividend yield of 1.5%, and it has been growing this dividend at a 3-year CAGR of 7.5%, which is extremely impressive when it's coming from such a stable, huge company. In terms of revenue and income evolution, the reason why it's so low is because its revenues have actually been decreasing in the 4 past quarters. Now, one good thing to note about this is that even though the revenue has been decreasing, their margins have actually been staying extremely consistent. Of course, you would generally want these to increase over time. However, Nike is such a mature firm that these not going down and actually them being able to maintain their margins is extremely positive. Additionally, we can see that this company is a monster at generating free cash flow. Of course, they had 1 quarter with negative cash flow, but the other 3 have been impressive, and these are resources that they will then use to pay out the dividend and to buy back shares. Finally, when looking at their leverage position, we can see that assets have been greater than liabilities for the past 4 quarters, and it is in a very stable position, which deems this company as being very safe in terms of its leverage position. Second stock we'll be analyzing is Starbucks, which we recently did a video about. As we can see, its stock price has dropped recently with their latest quarterly earnings, and it's right now trading at $76 per share, being around 29% lower than 1 year ago. Starbucks right now is trading at the cheapest it has in the 4 past quarters in terms of price to earnings and in terms of price to cash flow ratio, as you can see in the graph at the bottom. And additionally, this is another one of those huge companies which are pretty stable, very safe, which is managing to grow their dividends at a fast pace. Starbucks yields higher than Nike, as it currently holds a dividend yield of 2.91%, and it has a 3-year dividend CAGR of 5.6%. And the reason why the stock price is lower this year is because of the same reason. Its revenues, gross profit, and net income have been decreasing for the past quarters. And one worrying thing that Starbucks actually has is that the margins are actually trending down. Now, this is why the company is actually 29% down over the past year. However, Starbucks is a monster at generating free cash flow. We can see from their latest 3 quarters that they were generating increasing, very stable free cash flows, and then they decided to reinvest the majority of that in this quarter right here to do some more expansion and other types of investments. So we can expect Starbucks to keep returning very high, consistent, and stable free cash flows in the long term. Now, one thing that I do not like about Starbucks, which I did mention in my previous videos, is that it has negative equity. What does this mean? Well, it means that its total liabilities are a lot higher than its total assets, and this has been going on for, I believe, the past 4 or 5 years, and this to me is a red flag. However, I did do some more analysis for Starbucks, and it turns out that they are very safe when it comes to their interest coverage ratio. This is basically the risk of how many times they are able to pay their interest payments with their current net income, and it came out higher than 8, which tends to be okay for very big companies. Now, moving on to company number 3, this is HP Inc. Now, this is a bit of a different play since this stock is not near its 52-week lows. Right now, the stock is trading right around $30, and it has been flat over the past year. When it comes to the valuation ratios, it is a company which is very attractive. It currently yields a price to earnings ratio of 8 and a price to cash flow ratio of 8 times, which is one that only very slow growth and very uncertain companies tend to yield. However, HP to me is a very stable company, which is right now yielding a 3.63% dividend yield with a 3-year dividend CAGR of 10.4%. So this is a great dividend with an insane growth trajectory in the past 3 years. But when it comes to its revenue, it's actually not growing a lot. As we can see in their latest quarters, their revenue actually contracted. Now, when it comes to their margins, they're actually managing to keep these fairly stable. Now, their free cash flow did increase from quarter 2 2023 to quarter 4 2023, but then came in at basically 0 in quarter 1 2024. Now this may be due to a lot of reasons, but I believe it's mainly due to them actually investing in their operations, which may be investing in different manufacturing facilities or R&D. But when it comes to leverage, this company has the same issue as Starbucks, where their liabilities are actually higher than total assets. Now this to me of course is a red flag, but in this case the total assets and total liabilities are more or less the same. As we can see, they have been making the effort of increasing their total assets more or less to keep them in line with total liabilities, which is something that I do like to see since it shows them actually worrying about their leverage position. Now stock number 4 is Intel Corp. Ticker symbol INTC. Right now they're trading at around $30, which means that they're actually about flat for the full year. Now when looking at their valuation ratios, the price to earnings ratio may be a bit biased and not very reliable because this company has been operating at a loss for quarter 2 2023, quarter 3 2023, and in the 2 previous quarters its net income has actually been extremely low, meaning that it cannot be used to actually value the company. However, the price to cash flow ratio is actually a much better comparison of what is going on with Intel. Right now, it looks fairly valued as it is in line with what the 4 previous quarters have actually returned, except for quarter 3 2023 when this company was at its lowest valuation in terms of price to cash flow ratio. Now this company is yielding a dividend of 1.66%. However, bad news, their dividend was cut in 2023, which has made them return a 3-year dividend CAGR of close to minus 20%. However, I do believe that this is only headwinds and that this is already priced into the stock. So I believe that even though the dividend was actually cut down, this is better for the operating side of the business, and it's still a 1.7% dividend yield, which is pretty decent. Now we can see the stock price was actually kind of mirroring the revenue chart, as the revenue actually increased until quarter 4 2023, and then it fell in quarter 1 2024. Now in terms of the margins, it looks like it has been staying stable. However, this is because the axis is extremely large. As we can see, their operating margin and net margin have been going back up and down between being around 15%, 20%, or being of course below 0. But now in terms of cash flow evolution, I do not like this from a company where they have been actually returning negative free cash flow for the past 4 quarters. It's not stable, it's not predictable, and there are no signs of reversal for this company. Since this channel is called the Cash Flow Compounder, you may have guessed, we actually look for companies that return stable growing free cash flow, and Intel doesn't check that list. Now finally, in terms of the leverage position, they're actually in a very good position, as their total assets are more than double their total liabilities, and they are growing their total assets at a faster pace than their total liabilities. Now last but not least, we have CSCO Systems. Now I know this is a company that is not really spoken about a lot, especially in the YouTube community, but I do think that it classifies as a dividend company, which is at an attractive valuation. Now in the past year is only up about 3%, and its current price is $48. In terms of its valuation ratio, it has been cheaper in the past, especially in terms of price to cash flow ratio, but we will see later why this has been. Now in terms of dividend, it yields close to 3.3% currently and has a 3-year dividend CAGR of 1.8%. Now this may be characterized as a slow growing dividend. This is better than a dividend which is actually decreasing year after year. And now CSCO has actually experienced the same as the majority of these companies we have analyzed, where their revenue, gross profit, and net income has decreased in the past 4 quarters. And now their margins have stayed pretty stable, especially gross margin. However, in the past quarter, net margin and operating margin actually took a big hit and dropped lower. And this is why the company actually got more expensive when analyzing the price to cash flow ratio. As we can see, in quarter 3 2023 and quarter 4 2023, it had very substantial free cash flow generation. However, this has decreased in the past 2 quarters. Now, in terms of leverage position, its total assets are almost double those total liabilities, and the total assets have been increasing at a faster pace than its total liabilities. Thank you for watching. As always, this has been the Cash Flow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.